Today, we're unpacking a fresh speech from Michelle W. Bowman, the Federal Reserve's Vice Chair for Supervision, delivered at the Fed's Community Bank Conference in Washington, D.C. on October 9th, 2025. The headline is, "Community banks matter deeply, and the rules that govern them need to fit their size, risk, and business model, not a one-size-fits-all hand-me-down from the largest banks." So Bowman's core message is about tailoring, meaning aligning definitions, thresholds, and supervision with the reality of community banking. First, we define what a community bank actually is. Second, size the regulatory thresholds so growing but stable banks aren't tripped into heavier regimes just because inflation nudged their assets. And third, refocus supervision on material financial risk, not check-the-box burdens. She also spotlights practical fixes like making bank applications predictable and fast, give mutual banks clear paths to raise capital, and bring more transparency to supervisory practices, especially the scope of confidential supervisory information, also known as CSI. So why tailoring now? Bowman argues the current use of fixed asset thresholds is a blunt tool. They don't adjust the growth or inflation, so banks with steady risk profiles can inadvertently cross into heavier rule sets, effectively pushing down standards meant for bigger, more complex firms. Her fix is index the thresholds to growth, so the original policy intent stays intact over time. How to judge these rules. So she proposes a test for both new and existing regulations. So what problem does the rule solve? What does it cost? What alternatives exist? And using the community bank leverage ratio, or CBLR, as an example, she contends a calibration focused on how many banks could qualify, maintaining high capital levels, missed Congress's relief intent, and those basic questions. So fix one is to fix the application's bottleneck. So mergers and acquisitions or new activities often hinge on regulatory approval timelines that are unpredictable and costly when delayed, hurting target valuations, employees, customers, and IT integrations. So Bowman's remedy is clear information requirements, clear approval standards, and timely action within statutory windows. Support mutual banks. So she highlights a concrete transparency step. The Fed has issued frequently asked questions and 2 templates to help mutual banks raise capital with instruments that can qualify as common equity Tier 1 or additional Tier 1. An opening move that the board is prepared to refine as mutuals work with it. So you can also make supervision visible and risk-focused. So Bowman calls for renewed tailoring in exams, calibrated to size, risk, complexity, and business model. She notes that confidential supervisory information, CSI, too often shields practices from scrutiny. Revisiting CSI's definition and scope could boost transparency and accountability. She also warns that exam findings can cascade, affecting M&A options, liquidity costs, and management priorities, so ratings must reflect true financial condition and material risks. Bowman ends by reaffirming that her remit spans GSIBs to single-branch rural banks, and that right-sizing frameworks, together with the FDIC and OCC, is both necessary and achievable through sensible reforms and more appropriate supervisory approaches. In conclusion, Bowman's North Star is continuity of community banking. Keep these institutions strong by aligning rules to reality. Expect near-term movement on re-index thresholds, clearer and faster applications, more transparent supervisory guardrails, especially around CSI, and a steadier focus on material risk. The big idea isn't deregulation, it's fit. Regulatory scaffolding that preserves safety and soundness without smothering the relationship models that make community banks vital.